consumption is something that everyone is tracking. But again, it's very difficult to get a picture of the whole. One will look at the auto sales, one will look at the FMCG corporate numbers, and some of those seem to suggest that there is momentum in consumption coming perhaps from the top 20% of consumers. Yes. How clearly does that tell us what the state of private consumption more broadly is?
Yeah, I'll make a broader point. I think we have to get used to a new normal here. The old normal, pre-pandemic normal in India was one where private consumption was driving growth, where private investment was constrained, at least at the top end, by balance sheets. So large corporates were constrained by their balance sheet problems. You had secular stagnation characterizing the global economy. Exports, therefore, were very weak, growing at 3% between 2012 and 2019. And you had a financial system that was chasing retail credit, even at the low end. And I'm going to argue that all of that has been upended in this post-pandemic world, that we cannot rely on private consumption, that the constraint on fixed investment has moved from balance sheets to utilization, that we're now in a global economy where the growth for the next 6 quarters will be the strongest since 1940. Exports have been surging in the last 6 months, and you have a financial sector that may become a little bit more risk averse, at least to lend to the bottom end of the pyramid. So I think all of those assumptions in this new normal will have to be challenged. Let me start with your consumption question. I think the key to understanding the prospects of consumption is to step back and understand where we were before pandemic. And while all of us celebrated private consumption growth between 2012 and 2019, I think there wasn't an adequate enough recognition that a lot of this was being driven by households running down savings and taking on debt. Just look at the aggregate GDP numbers. Disposable income to GDP between 2012 and 2019 fell by 2 percentage points. Right? And consumption to GDP in that period rose by 4 percentage points. As a result, household debt, which began of low levels, so they weren't concerning to start with, almost doubled over a 6-year period. Now, borrowing to consume made sense for a young aspirational population when you have robust expectations about the future. This is just a way of smoothing consumption. But by 2018, as the economy was into the second year of a slowdown, our sense is incipient balance sheet concerns began to arise. Just look at the RBI's consumer confidence survey. What you'll find is by early 2018, the perceptions of contemporaneous income, after holding up well for 4 or 5 years, had begun to drift down or drift down even further. And so the key point I wanted to make is private consumption had begun to slow in early 2018, much before the NBFC shock. You see this in retail credit by banks. If you take out mortgages, it's even clearer that this starts in early 2018. You see this in the IP data, and you see this in the perceptions, the survey data from the RBI. This is important because there is a school of thought that says, well, consumption only began to slow after the 2018 IL&FS shock because of tighter monetary and lending conditions. If we can reverse those lending conditions, consumption will pop right back up. That's not the thesis that I'm working with. What we believe is it began to slow before IL&FS because of these balance sheet concerns. Now, if that's your hypothesis going into the pandemic, and you believe there's a fair amount of scarring through the pandemic, when I spoke about that 7% shortfall, the fact is employment to population will still be 2 percentage points below pre-pandemic levels. And just look at those RBI surveys. We got a survey Friday night from the RBI. If you look at income perceptions, employment perceptions, spending perceptions, general economic perceptions, these are much, much more depressed compared to pre-pandemic levels. In fact, they haven't even gone back to the March levels. So if households were worried about their balance sheets coming into the pandemic, and there's been more scarring in the pandemic, it's hard to expect that you're going to get a big booming consumption recovery. You will, of course, get pent-up demand, and we should not conflate that over the next 6 months with what the underlying trajectory of consumption is. But hard to imagine that with consumption slowing for 2 quarters before the pandemic, that after the scarring, consumption steps back up and starts growing at 7-8%. There's no doubt that there is a price effect here. Real interest rates are lower. Monetary conditions are much easier, but I would argue the income effect on the balance sheet will swamp the price effect. One last data point, there are all sorts of data points, but let's just take the auto sector since you brought it up. If you go to between January and July, look at the actual registration data of autos, 4-wheelers and 2-wheelers. Compared to 2019 levels, which is a baseline, Four-wheelers are down about 7%. Two-wheelers are down 30% compared to 2019 levels. So, and this ties up with the RBI survey where when households are asked, where will your discretionary consumption be? These are record depressed levels by the standards of that survey.
Interesting. Let me throw a few counter questions at you just to sort of, get a clear sense of what you're thinking. So there is one hypothesis out there that given a large part of the discretionary consumption perhaps comes from the top 10 or 20% of the Indian population, and these are the people who are at the top end of the K-shaped recovery. They're feeling the wealth effect from higher asset prices, capital markets, etc. And that is the segment which will sort of push consumption in the post-pandemic world. Yes, unfortunately and worryingly, inequality has deepened, and the lower income end of the population has taken a hit. But they may not, sort of drive the boost to consumption even in normal times. Do you buy that?
Well, I think, again, we should kind of maybe not conflate one-time effects with more enduring effects. I completely agree that the top 10% account for a large bulk of the consumption spending. But think of what we're saying. If it's pent-up demand, if there's excess savings like US households have, that's a one-time impact. Whereas at the bottom of the pyramid, if you've got the bottom 20 or 30% who've either lost their jobs or have heightened income uncertainty and have to raise precautionary savings, that's a recurring impact. Number one. Number two, when we think of a K-shaped recovery, my sense is, and this is not just true of India, this is true of many countries around the world, when the dust settles on the pandemic and you break up GDP by income shares, we should expect to see income to GDP of the top end go up for the reasons you mentioned, and income to GDP of the bottom go down. Now, essentially what that means is income is being transferred from the bottom to the top. And for every $1 that moves from the bottom to the top, the marginal propensity to consume is actually lower at the top than at the bottom, right? So in the steady state, one should expect consumption to shift down, not up. And we just have to look at last year's numbers. We now have the data for all of FY21. There was a belief that private consumption drove the entire recovery between September and March. But we now have the data. Among all the drivers of demand, consumption, investment, government spending, exports, consumption was the slowest and the weakest to recover back to pre-pandemic levels. The recovery in the second half was driven by massive public investment by the central government, where CAPEX grew by 75% in the second half. Exports played their share in the Jan to March quarter. So government spending, investment, exports recovered to pre-pandemic levels much faster than consumption. So I'm a little bit more cautious on that hypothesis that, this pandemic's over and consumption will be back to the rates we've seen in the past.
Fair enough. On the question of household debt, again, like you said, the data clearly does show that uptick. On a global scale, I saw a chart in your report as well. It's not like household debt is very low in India anymore. So certainly that could play a part, even if there is willingness to lend. For instance, there are a host of NBFCs, fintechs, etc. We see money going after small ticket consumer lending. But the income effect, as you said, if you don't have the sort of income to repay those loans, perhaps you'd be that much more cautious.
That's right. So to be fair, again, India's household debt, and we need to be careful here that the data, we've had to splice two series. There's data from the BIS, data from the RBI, we've spliced them too. But we're still below emerging market averages. So it's not like household debt, is a binding constraint, but all of this is contextual. I think levels of debt influence consumption when interacted with expectations of future income. If you've got robust expectations about the future, then even higher levels of household debt don't become a binding constraint. The worry really is that given the scarring and given how we came into the pandemic, households, at least in those surveys, multiple surveys, seem wary about the future. And when that happens, they typically tend to retrench. So I think it's going to be those expectations married with the levels of debt that perhaps in the near term become a bit of a constraint.